Only mode.
Well, welcome to the AWB Tax webinar on capital gains tax. We thank you for your participation today. We hope to be able to share with you what exactly is going on with the capital gains tax, why the governor and lawmakers are asking for this particular measure, and to give you an idea of the structure of the capital gains tax and how it will impact taxpayers in our state. We'll conclude the webinar by sharing with you the latest on legislative activities as it relates to the capital gains tax and what the prognosis for passages in the 2015 legislative session. One more time. Just back here. So the governor came out with his budget request that includes a variety of tax increases, most notably the capital gains tax. His overarching reason for establishing a capital gains tax was to increase the share of state taxes paid by our state's wealthiest taxpayers. This sentiment has been expressed by multiple lawmakers, including the governor. The comments go on and say that only the tiniest portion of taxpayers will be subject to this tax, and that since our state has not been able to generate enough revenues over the last several economic recessions, more revenue is needed, and that they consider this a fair way to raise taxes to help fund education. In the House, 1484 has been introduced by a variety of lawmakers. Many of these lawmakers share the same sentiments that have been expressed by the governor's office. The bill is currently in the House Finance Committee. In the Senate, Senate Bill 5699, same situation. A number of lawmakers have sponsored the governor's request bill. The bill has not had any action yet in the Senate Ways and Means Committee. This issue really comes down to how will the budget get put together. So we might not see action right away, but the goal of the governor's office is to raise state revenues by about $798 million in the upcoming biennium, and then in the following biennium, it would bring in about $1.8 billion. So as we're looking at the budget and how we get to a solution by the end of the year, many lawmakers are looking at this as a viable option to help close that budget gap and to fund our McCleary obligation under education. I'd like to hand it over to Ron Bueing from Pricewaterhouse Coopers, Director of Taxation there. Ron has more than 30 years of experience working in taxes with taxpayers and has a law degree from the University of Washington Law School. Ron is also the chair of AWB's Tax and Fiscal Policy Council. And Ron, we're going to go ahead and hand it over to you now to start talking about the structure of the capital gains tax.
Okay, so this capital gains tax proposal is like something that we have never really seen before in Washington. It's becomes effective January 1, 2016. Hopefully all of the court challenges that are undoubtedly going to be coming up will be done by that time. And it would impose a 7% tax on individuals. Doesn't apply to corporations, partnerships, S corporations. We'll talk a little bit about flow-through from those entities, but it does not apply to the business organizations themselves, but to individuals. It's a 7% tax for the privilege of selling or exchanging long-term capital assets or of receiving Washington capital gains. The specific language that's used in the statute, the proposed statute, based on the privilege of selling or exchanging long-term capital assets, is largely done to, at least by means of form, to indicate that this is an excise tax as opposed to an income tax, which under previous court decisions in Washington, an income tax would have to meet certain strict features in order to be constitutional. And so the idea here is this is an excise tax similar to, say, the real estate excise tax or the Washington B&O tax or the sales and use tax, which would then be able to pass constitutional muster in Washington. So you get the 7% tax. You have various exclusions and deductions. The law would also add a Class C felony for evading the tax and a gross misdemeanor. So we have criminal penalties that are associated with either evading this tax or for simply failing to pay the tax, make returns, keep the records, and provide any information that the Department of Revenue requests. And then the other major structural part of the proposal is that all revenues must be deposited into the Education Legacy Trust account. Now, kind of going through the structure here a little bit, what is taxed under the statute? Well, actually, I think the actual term under the statute is that they adjust Washington adjusted capital gains, but what's really being taxed are net long-term capital gains. These net long-term capital gains do not include short-term capital gains. They are not offset by net short-term capital losses. There is also no carryover or carryback over years. So a taxpayer that has a large capital gain in one year and a large capital loss in the next year would not be able to benefit as they can on the federal end from the ability to carry back those losses and use those losses to offset capital gains that had been taxed in previous years. So we're just looking on an annual basis, and we're looking at the net long-term capital gains. You also would have to add back, to the extent that in computing the federal long-term capital gains, you would have to add back any capital losses that were included in your capital gains calculation that came from exempt sales. And then finally, you would exclude any long-term capital gain, of course, that are from exempt sales that had been included in your long-term capital gains. There is another provision that basically includes within the net long-term capital gains any gains that are from the sale of assets that might not otherwise be treated as capital assets, but from which the gain is treated as a capital gain, and this would include 1231 gains and other gains that are treated as long-term capital gains. The interesting part of this I found in looking at it, I'm not sure exactly how this would work ultimately upon implementation, but the normal types of assets, for example, that would cause long-term capital gains would be depreciable assets that taxpayers hold and are used in a trade or a business. But although the reported capital gains portion of those sales of those 1231 assets, while they're specifically would be included within the capital gains tax, there's also an exclusion we'll talk about later that excludes the sale of such assets. The tax does provide for a deduction for the individuals. It's $25,000 if your individuals married filing separately, $50,000 for couples filing a married filing joint return. So the first and it's set up as an actual deduction, so no one pays on the first $25,000 / $50,000 of capital gains. I had mentioned before that while it does not tax businesses, what it does tax is an individual's share of capital gains that come through pass-through entities, and this would include partnerships, LLCs, S-corps, trusts, which would, of course, include real estate investment trusts. So although there would not be a tax that 7% tax would not be imposed at the business level to the extent that capital gains are incurred by a business and are passed through to the partners, the members of an LLC, the shareholders in an S corporation. Those individuals would be required to include those capital gains and pay tax on those capital gains. Your marital and status and filing elections from the federal returns are generally applied under the statute. So if someone files married filing joint at the federal level, they would be required to use that same status in dealing with the capital gains tax proposal. There is an interesting deduction that is provided that is supposed to deal to an extent with the possible taxation of gains under the B&O tax and under the capital gains tax. And the way this would work is that a deduction would be allowed under the B&O tax to the extent it was necessary to avoid taxing the same amounts under the capital gains tax. And remember, this would generally only apply in the context of an S corporation, partnership, an LLC that was passing through capital gains taxes. Of course, the capital gains tax, although it is based on the gain, the net capital, long-term capital gain, it's not based on the gross receipts as we have at the B&O tax level. The tax is substantially higher. The tax comes in at 7%, so that is a significant increase. The other thing to note is that a sale of real property, for example, within a partnership, an LLC, or any sort of a business, ordinarily under the Washington B&O tax, we do not tax the proceeds from the sale of real property, or the rental of real property for that matter as well. But and then in this context, the sale of real property is is the area that we would be concerned with. So sale of real property not subject to tax. Accordingly, you wouldn't need a deduction. You would still flow through those gains, even though it was not taxable for B&O tax purposes. The gains on the real property, to the extent they're long-term capital gains, would flow through that flow-through entity, partnership, LLC, S corporation, would flow through to the individuals, would be reported on their tax returns, and would be subject to the 7% capital gains tax in Washington. There are numerous deductions under the capital gains proposal to deal with items that that would ordinarily, I guess, they would be incurred by everyone, but are more likely to be incurred by individuals. And this takes a lot of the pressure out of where most individuals would come up with their capital gains. Number one on this is the gain on the sale of a principal residence. There are actually two different potential opportunities here to eliminate the gain. One is that if you've really held the property for a long-term period, so if you've held a property for 20 or more years, ending on the date of the sale or exchange, and you've used that property as your principal residence for periods aggregating at least 10 years. In that case, then the entire gain from the sale of that principal residence, even if it exceeds the federal exclusions, the entire gain would be exempt from the capital gains tax proposal. If you do not meet that long-term exception, then you would fall into your normal, the same rules that you would generally have at the federal level for a sale of a principal residence. You go to Section 121 of the Internal Revenue Code. I have to admit, it's been a little while. You have to have owned or used the property as a residence 3 out of the past 5 years. But there are requirements under Section 121. If you meet those requirements and you're allowed to exclude your gain from the sale of your principal residence, you're allowed to exclude $250,000 on a married filing separate or an individual return, or you can use up to $500,000 on married filing joint return. Those Section 121 capital gains would also be excluded from the capital gains tax proposal. And to the extent state-registered domestic partnerships are made eligible as well for this married filing joint exclusion of up to $500,000. There are a number of other deductions. One of the big ones is capital gains from assets that are held in retirement accounts. So this would include 401ks, 403bs, all of those numerous different retirement accounts that are out there at the federal level, assets that are held in those accounts, any capital gains that accrue from sales of assets held in those retirement accounts would not be subject to the capital gains tax. Capital gains from the sale of assets that are sold under a threat of eminent domain or are required to be sold under eminent domain, those would also be exempted. There is certain sale exchanges of cattle, horses, and breeding livestock. There are also some an exemption related or exclusion related to the sale of agricultural land that meets certain specific requirements under IRC Section 469H for the 10 years prior to the date of the sale. And this is the one I mentioned a little bit earlier. You would exclude capital gains from the sale of tangible personal property that's used in a business that would qualify for an income tax deduction under IRC sections 167 or 179. 167 is assets that you would depreciate. 179 would be the expense where you're allowed to expense certain long-lived assets for Internal Revenue Code purposes. Any of those assets, gains from the sale of those assets, would not be liable for the capital gains tax. And then in an attempt to avoid certain, there are certain provisions under the federal law where an election can be made under IRC section 631A or B to treat certain proceeds from the felling of timber to be to fall with in the capital gains tax treatment. And this, and they have a provision that attempts where those provisions are used, that the capital gains would not be, those capital gains would not be included within the ambit of the capital gains tax. Oops, I think I moved too fast there. Making sure that I'm getting everything here. Sorry to be moving around on the slides there a little bit. Okay, the rules of allocation. Of course, with a capital gains tax proposal like this, you have to have some rules for allocation because you cannot obviously tax the sale of items that are not related to either persons within Washington or property within Washington. So they do have allocation proposals to address those more or less apportionment questions that would come up. The first of these is that adjusted capital gains from the sale or exchange of real property that is located in the state of Washington are allocated to Washington. Also, if a majority of the fair market value of property is located in this state at the time of sale or exchange. I am assuming that, and of course, we wouldn't have any regulations, but I think the idea would be that if you can determine the gain by specific property, you would then allocate according to property. But if you're, saying, receiving a distribution from a partnership, a REIT, some sort of an investment type of an vehicle where there may be multiple sales of property located in different places throughout the United States, you would only have to include those capital gains to the extent that a majority of the fair market value of that real property was located in Washington at the time of sale or exchange. I can see this one as being a bit of a nightmare and would ultimately probably require substantial regulations to get anything that's really usable there. There would also be adjusted capital gains from the sale or exchange of intangible property. So this is a big one, obviously, stocks, bonds, et cetera. That is allocated to the state of Washington if the taxpayer is domiciled in the state at the time of the sale or exchange. I guess that if you have large capital gains coming, you want to move somewhere else is basically what that provision is telling us. Other rules on allocation. Adjusted capital gains from the sale or exchange of tangible personal property that are located in Washington are allocated to Washington. So tangible personal properties in Washington is located to Washington. Well, you might say, well, if people just take that tangible personal property and move it outside the state. Of course, the law anticipates that. So any property that was sold or exchanged that was located in the state of Washington at any time during the taxable year in which the sale or exchange occurred is where the taxpayer is a Washington resident at the time of the sale or exchange would be subject to the capital gains tax. Now, there are certain provisions for if you have to pay income or excise tax to another jurisdiction that would provide a credit. Those credits are allowed for income or excise taxes paid to other jurisdictions. The credit would be applicable if the tax was paid, but only to the extent of the gain allocated into Washington, and it would be a non-refundable credit, so the credit would only apply to the extent that it offset the Washington liability. There would be no provision for carryover as well of any excess credits. Okay, so that's kind of just the structure of how the tax works. The second part I wanted to address here a little bit is how will the governor's proposal impact taxpayers? And these are questions that I'm not an economist. I cannot necessarily answer as to how these effects will come about, as many of these do have to do with an impact on the economy in Washington. I have gone out, however, and did a little looking to see what others have said, and some of the comments that have come up on how the governor's proposal will impact taxpayers. Several of the comments relate to volatility. The capital gains tax, well, income taxes in general are highly volatile. You know, when we have a downturn in the state of Washington, and there's usually always a decrease in sales and use taxes because people quit buying as many items. You also have a little bit of a decrease in B&O tax because gross receipts go down. But the volatility in those taxes is nothing compared to the volatility in an income tax, because while gross receipts might go down substantially, you still have most of your gross receipts available. And while taxpayers will quit purchasing, there's still a number of items that they have to purchase. So there really is a less volatility with respect to those two types of taxes. The income taxes are very volatile, and capital gains as a subset of income taxes are more volatile than income taxes. So you know, one of the concerns is that this is not a tax base that is easily relied upon, and consequently some of the commentary that was out there prior to the governor's proposal suggested that the only way a tax such as this should be used in Washington would be if there was some sort of a rainy day fund or some sort of a provision to kind of level out those taxes so you don't get into the problems with the extreme volatility of the tax stream. And that is not included in the current proposal. Deductibility of the taxes for income tax purposes is interesting. As I mentioned earlier, the idea of the governor is that this should be structured as an excise tax in order to be constitutional for Washington purposes under the Constitution. If the tax is an income tax, then there are certain requirements with respect to the amount of tax and with respect to the uniformity of that tax that would necessarily could be violative of those provisions and would strike down the capital gains tax. So it's been structured to be an excise tax. But if that characterization holds up at the federal level, and I admit it's not necessarily the same characterization at Washington and at the federal level, because federal rules are much, at least to this point, historically have been much more along the lines of looking at the characteristics of a tax as opposed to the form and nature of the words used to implement the tax in order to determine whether it's an income tax. If the tax is not an income tax, it's not deductible by individuals, and that would be the problem. So we'd have a very significant tax imposed by Washington that, if it is an excise tax, would not be deductible by individuals. There's been some indication in some of the commentary of the effects on the dynamism of the Washington economy and how that would be affected. This comes from a couple of different perspectives. One just is the added cost into the system. Another has to do with the potential movement of capital outside of Washington for individuals that are possibly facing large capital gains taxes, and then also from the standpoint that if there is a higher cost from a tax perspective of disposing of capital assets, there will be a greater incentive to hold on to those assets for a longer period of time, and thereby deferring that payment of tax, and that would have certain effects on slowing down of the Washington economy overall. It's uncertain. Some commentators have said they would have virtually no effect. Others have indicated they believe that there would be a measurable effect. But there have been those concerns with respect to the tax. And then one of the last things that I saw out there, that how it would affect Washington residents, and granted these are effects that are beyond just the effect of actually paying the tax, is that there's arguably could be an increased cost in the form of commercial and residential rents, because the 7% capital gains tax is going to have to be paid in connection with the sale of these properties. It's likely that that is going to be a cost that's ultimately going to be borne by the users of those properties at the end of the day. So anyhow, that is the presentation that I had on the structure. And I have room for some questions now, or we can go into Amber's
let's go ahead and take some questions, Ron.
Discussion.
We've got a few queued up here. I'm going to start with the first one. Comment on the rules of allocation. Brought up the question, could there be double taxation by other states?
Could there be what? I'm sorry, was that again?
Double taxation. So if somebody moves an asset and we have the law that prevents, that focuses on domicile location, can that tax then be double taxed by another jurisdiction?
It is entirely possible that there could be a tax by both jurisdictions. Now, there is indeed a credit mechanism that is intended to prevent double taxation. It would depend largely on the rates in the other states. So you could have a situation where, say, for example, you had property that was taxed by both Oregon and by Washington, and the way that the overall structure is made is that you would have your Washington, you compute your Washington tax, and then you would be allowed a credit if Oregon was to tax those same sales of properties. Now, in the case of Oregon, their tax would be, roughly, I think at the top end around 13.3% or something along that line. So you would get a credit. It would wipe out your Washington liability. On the other hand, you could be in another state where the taxability of capital gains might be at 5%. So in that case, then you would have taxability by the other state, and you would then have taxability in Washington. And you should just pay, in essence, a combined rate of 7%. So there are credit mechanisms in the law that would supposedly prevent this double taxation, so that it would be a limit of essentially 7%, at least at the Washington level. But if the out-of-state component has a, if they have a greater tax rate, the overall tax would be more. But then arguably those taxes would have been paid otherwise. So there shouldn't be double taxation. A lot of that comes down to the regulations and how this all gets figured out. And the devil's always in the details. So I'm sure there would end up some circumstances where there could be some level of double taxation.
So another question from one of our listeners. They're asking if they heard correctly. Structuring this tax as an excise tax to keep it legal means that it's not deductible on federal taxes. Did they hear you correctly?
Yes, they did. It's a question that's not entirely it's not entirely clear, and the reason, like I said before, is that how Washington might define a tax as an excise tax versus how the federal government might define an excise tax. So certainly, if both the federal government and Washington use the same definition of what is an excise tax, then this would clearly be an excise tax, would clearly not be deductible on your federal tax returns because it is an excise tax. And the alternative would be an income tax for both purposes, and arguably would be unconstitutional, so you wouldn't have to worry about a deduction for it. But there is the possibility that the federal government could find the capital gains tax in Washington to be an income tax and deductible, while the state could still find it to be an excise tax. And that just comes down to the fact that you're governed by federal rules with respect to the deductibility question for income tax purposes, whereas you are treated differently at the state level, where you have state rules that are determining whether it's an income tax or an excise tax.
The next question from our listeners: would there be a credit from the capital gains tax for real estate excise tax paid?
No, there is no. In fact, it's very clear under the statute that all of your existing taxes continue to apply regardless. So there would be both. You would continue to have the real estate excise tax, and the capital gains tax would be layered in addition to the real estate excise tax that is paid. So it's completely an add-on tax for the capital gains tax. There is no reduction in the real estate excise tax.
Next question. The Supreme Court has called for dependable revenues to fund education. Do you think the justices would accept this kind of volatile revenue source for funding McCleary? As currently structured, I'm not certain that they necessarily would. It is possible. I hesitate sometimes to figure out what in the heck our Washington Supreme Court would do on certain issues. But this is definitely it's a highly volatile tax, and if it was the only tax that was available to handle that, I'm not sure it would necessarily be sufficiently stable for those purposes. Especially given that there's currently no method of kind of leveling it out by providing some sort of a rainy day provision that would allow it to allow for an accumulation in good years to offset the reduction in the future years. So just to remind listeners that if you have a question, type them into your screen and we'll make sure that your question is answered. Let's go ahead and move into the next portion of the webinar to give you an update on legislation. But again, remind you, if you have questions on the structure or any of the other topics we've talked about so far, don't hesitate to shoot your question in. As I mentioned earlier, both the House and Senate bill are currently not moving in the legislative process. Both bills have been referred to the fiscal committees of the House and Senate. Neither the House or Senate has had a public hearing on this issue. It's well understood in Olympia right now that any tax increase measure that is produced will be part of the end game discussion on the budget. For lawmakers right now, they're focusing on the budget, trying to get some basic agreements on dollars amounts that are needed, how much money to put into education funding, and they've not yet got to the point of a conversation on, is revenue needed from both the House and Senate's perspective? If so, how much, and which tax will be used to bring in that revenue? We have expressed some concerns to lawmakers, however, already on the topic of capital gains. Most notably, we try to impress upon lawmakers that want a different tax structure in our state, that the simple imposition of a capital gains tax is not tax reform. It does not do away with the regressivity of our state sales tax. It does not do away with the lack of fairness in the B&O tax system. It is simply not tax reform. We believe that capital gains is a tax on income, despite the way the bill has been drafted to try and accommodate being an excise tax. At every point, we hear lawmakers referring to the income tax forms in order to gain the information to apply a state tax to those same taxpayers. It's been categorized as an income tax by various documents at the Department of Revenue. Historically, courts have struck down an income tax in our state, and this is viewed as perhaps a way of opening that conversation again to the courts to look at that core decision on whether or not income tax is or is not constitutional. Juan has already highlighted some of the areas that a capital gains tax could hurt the economy with regards to increased costs, the dynamism of our state, especially when it comes to liquidations and recovering from the recession that we're in right now. It is well understood that capital gains taxes are volatile. They are unpredictable. And when you look at the last fiscal note from House Bill 2563 in the 2013 legislative session, this was called out very specifically that capital gains are extremely volatile from year to year. Revenue from this proposal depends entirely on fluctuations in the financial market and can be expected to vary greatly from the amounts presented here in the fiscal note. The point being is if you're expecting to raise $798 million in 1 year, that same $798 million might not be available in the ensuing years because of the fluctuations and the timing of making sales in the market. And there will be quite a bit of employer activity to try and focus on whether Washington is the right place to continue to be domiciled. We have also expressed our concern about the rate and whether or not, if this package does go forward, how can you make sure that 7% is not just the start and that 1% is not just the beginning of who will pay this tax and at what price? History has shown us that taxes start low, but they increase. The first Washington state sales tax was 2%. Now the state rate is 6.5%. The federal income tax started at 1%, applied only to the very wealthy, and now applies to virtually everyone. So without some assurances that these taxes aren't just going to continue to creep, to be imposed on top of existing taxes, there is a reluctance on the business community in order to advance this particular proposal. We've looked at the map provided by the Tax Foundation, and for those that have access to the slides, Washington is currently ranked number 42 in the nation because we are one of 9 states without a state capital gains tax. So the imposition of a 7% capital gains tax will immediately, overnight, change that competitive ranking and increase our rank to number 11 from the 42 rank that we're at currently. So you would see an immediate impact for those looking at our state tax rate and what would be expected. The fiscal note for this year focuses on the fact that there will be challenges on the constitutionality of this proposal in Superior Court. They even go as far as saying up to 5 different challenges on this particular tax proposal because of the questions over constitutionality. Some are concerned that this is the gateway to open up the bigger argument of the Miller decision back in the 30s on not having an income tax in our state. But the fact is this will be a very contentious issue if it does go forward. It will be very costly to implement, and it will incur legal expenses for the state as well as taxpayers. So we have some more questions that have come up. Ron, do you think this would open the door for a state income tax?
Yeah, that's always a difficult question to answer. I mean, the Washington taxpayers have shown a reluctance to adopt an income tax, and the one way that it might, I would say, open up the door is that, and this is actually certain groups have actually indicated that their thought that the main benefit of this tax is that it would go up before the Washington Supreme Court, and there would be an examination by the current court of these older decisions. And remember, these decisions we're talking about on the taxability of on the income tax are going back quite a ways, and there's some hope in certain quarters that if the capital gains tax proposal came forward, the court might look at it and say, well, you know, you're right, it really is an income tax, but you know what, we've re-looked at our Constitution and we think that's perfectly fine and allowable. And so in some ways, if you got that type of a decision out of the Washington Supreme Court, it could open up the possibility for the legislature to then be able to to put forth an income tax without worrying about the constitutionality. It also would not require a constitutional amendment, and that would perhaps make it possibly make it easier to get through. And I think, truthfully, although we've seen maybe a little bit of erosion of the anti-income tax sentiment in the state of Washington, I'm not so sure that regardless of what they do in Olympia, that we're going to erode very much the Tim Eyman-led initiative that would almost assuredly show up to eliminate any sort of income tax that the legislature might attempt to put into place. But I mean, certainly there's public sentiment has I think changed on this issue a little bit, and we could get a different environment from a judicial perspective.
So next question, the capital gains tax is portrayed as a painless way for the 1% to pay more. Is this the full story? Are there impacts on the state economy from this kind of tax?
Well, I mean, I think any tax is going to have a certain amount of impact, and I'm not an economist. And I've heard differing viewpoints out there on on how much this would have an effect overall on the state of Washington. I guess it's painless to everyone but the 1%, so to speak. Although I think that to say it's just the 1% is really not correct. And maybe you think about. I just think personally of a situation that we had where we had property that had been purchased years and years ago, and it, as a person's share of an estate that had been purchased property that that we had that had been around for 40 years or so and had significantly increased in value. Original thought was to build a home on it, but ultimately that didn't turn out to be right. Well, that sale would have certainly come under come to significant taxation under the under this 7% tax. So it's not as if there's some sort of a protection for the fact that someone is not in the 1% or not even in the top 20 or 30%, that they would not have to pay this tax. It's not as frequent, but it would certainly affect others. I don't know, kind of a long-winded answer to a question that I'm not so sure that I actually have the answer for, but there could be significant effects in terms of movement of capital and items along that line, according to some commentators.
And I'll just add that you may remember a couple of years back, Initiative 1098, the income tax initiative on high earners. That initiative primarily lost in our state 64 to 36%, because voters were concerned that over time the threshold level would be lowered to cover them, and they will be included, exemptions would get eliminated, tax rates would increase. So there's concern about this expanding beyond the 1%.
It certainly is you make a really valid point there, Amber. That very it does open the door. If it's okay on the rich, then it does open the door to extend it down further and further, eliminating either the exemption or eliminating some of the deductions for certain types of property sales.
So we have another question, a little bit more technical in nature. Section 106(1)(c), the tax on the capital gains of the sale of an intangible. Does this not bring the taxation of the sale back into Washington when our recent changes in B&O tax have made the taxability based on the place of use?
Okay, so this gets at the idea of, so in Washington, we more recently had I believe this is what the question is getting to. In 2010, we made a fairly significant change in our apportionment with respect to certain services and royalties income, that instead of taxing it to the commercial domicile in Washington, that we began to tax where more or less where the benefit of either where the intangible was used or where the benefit of the service was received. While the idea is largely to get after a lot of out-of-state credit card companies and to have them start paying tax in Washington, there was also this idea of sort of reducing the tax on businesses and individuals located in Washington while increasing exporting, so to speak, our tax to businesses outside. And arguably, the sale of intangibles would be handled in this manner in a different fashion because it would be on commercial domicile. So it would definitely fall on those persons that that own that intangible property that are domiciled in the state of Washington, which is arguably contrary to the theory that is used in connection with the income from those same intangibles, which is allocated to where the intangible property is used as opposed to the legal domicile of the person. So I would agree that it is arguably contrary in some ways to that principle that we kind of adopted in 2010.
Well, there are no other questions. At this time, I'd like to thank the participants for joining us on this informational webinar to learn more about capital gains, the reasons why the advocates are asking for this proposal, the structure of the tax, and where we are in the legislative process. But before we do that, we do have one more question. Fiscal Note says that by 2019-2021, we will have 1.8 billion in taxes. Fiscal Note assumes 32,000 taxpayers will be affected. That means each one of those taxpayers will have 830,000 in CG each year. Does that make sense?
Okay, so this was getting to the fiscal note, and it was, and I have to admit, I was listening to this. At first, I was thinking, a fiscal note question, and this will go to Amber. But so this was, I take it this was noting the number of individuals that would be affected, and essentially dividing that fiscal note, and then determining what the what an average impact is. That the import of the question, and is that realistic? Is that
that looks like the gist of it.
Okay. I mean, I think one of the other things that I've heard on this text from, and then the people have put together the numbers on this. I know Drew Shirk from the Department of Revenue was involved in putting together the numbers on this, and one of the comments that I believe that he made at some point in time was that over half of the tax would simply go to the top 1% in Washington. So I mean, I have to admit, the average sounds a little off to me in terms of the how that would work, but but arguably, based on at least what the state is thinking, there would be a very significant effect at the very highest levels, and a significantly lower effect. Surprised the average would be that high.
Okay, now that is the end of our questions, and we would like to thank you for participating today. I want to apologize for that Representative Carlisle could not join us here today. It is the cutoff date for policy committees, and he was unexpectedly detained at the legislature to address some policy matters. We will have him in future webinars to talk about his perspective on this issue. But we do apologize for his lack of participation today. We hope that you found this information useful to understand the governor's proposal on capital gains tax better. If you have questions after the webinar, please forward them to me and we'll get answers to you. Next week on Friday, we will have another webinar on property tax levy reform, which is a core component of the McCleary court decision on education funding for the locals to not rely so heavily on property taxes collected at the local level. We hope you'll join us next week as well, and again, thank you for participating today.